All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been researching investing in real estate using life insurance, you've come to the right place. So be sure to like and bookmark this channel. You'll want to watch the rest of my videos. Today, I'm digging deep into the Double Play archives again, and I'm resurrecting the last of my old videos that I have not completely edited yet. Today we're going to be talking about what a reasonable return expectation is on a life insurance policy. And the core of what I'm going to be talking about in this video is still just as valid today, 4 years later, as it was back in 2020. The only thing that's different now is that the actual rates and dividends are considerably different today. And if you can recall back in 2020, we were at the lowest extreme of interest rates. And now 3 or 4 years later, we're facing an inflationary economy, and interest rates in prime are very high. So take everything with a grain of salt. The core principles are unchanged in how to do the analysis, but the tables and graphs that I'm going to be showing, unless I can easily swap it out, are going to be a little bit older. So with that, let's jump back into the presentation and hear from 4 years ago me. Take care. Enjoy. So today we're going to be talking about the appropriate rate of interest or dividends to use when you're doing a life insurance illustration. And again, with the interest rates as low as they are today, is that the right interest rate to use on a life insurance illustration? This is going to be in place for many, many years. As I stated in the intro, I painted the picture of what if the interest rates were to decline, and I showed how disappointed you might be that the policy is not keeping up with what you were expecting. But today, with interest rates as low as they are, if we were to use the very low interest rates, you would find that hopefully, if interest rates ever go back up again, the policy is going to exceed your expectations. But at the same time, you might be looking at today's low interest rates and thinking, well, why would I do this? This is not very good. So we're going to go over what the appropriate interest rate should be, or dividend rate in the case of whole life. But in addition to that, I was in a conversation on one of the real estate investing forums last week, and somebody was talking about the return on the premium. And if you've followed any of my videos before, you understand there's a big difference between a maximum overfunded life insurance policy and a minimally funded life insurance policy. So if we think of the interest or dividend as the return on the cash value, you can see that it makes a big difference, or policy design makes a big difference in how that policy is going to perform. And so I want to address briefly, before, as we get started, why you shouldn't be looking at the return on premium, and that you should be focusing on the cash value portion of a properly designed policy. So in order to do that, we're going to start with my typical Life Insurance 101 presentation, because I want to make sure, if you've never watched any of my other videos before, I want to make sure that you've got the fundamentals that you need to understand and grasp the concepts we're going to be talking about here. If you've already watched the videos and you've seen all this before, I'm going to put a timestamp on the screen so that you can just jump ahead and jump in at that point. But I also want to stop and point out that I do have links to my Life Insurance 101 paper and the Life Insurance 101 video in the description. So please go down there and check those out if you need to brush up on that, or if you want more information, because I'm going to just give a brief overview today. But also, while you're down in the description, please like and subscribe to this channel so that you can get notified whenever I put out new videos. So the way we're going to do it today is, I want to start with the Life Insurance 101 presentation. And I want to start with policy design and show you the difference between a minimally funded life insurance policy and a maximum overfunded life insurance policy. I'll show you what the cash value of a life insurance policy represents, and what the insurance company does with the money, because that's really what we're after today. And then once we've got the fundamentals down, then I'll look at how we should look at the interest rate or dividend rate on a whole life, and then we'll switch over and cover indexed universal life, and then we'll wrap things up. So let's get started. All right, so let's get started with life insurance 101. Permanent life insurance is a very complicated product, or at least people perceive it to be a complicated product, and it doesn't really need to be that way. So term life insurance is really easy to get your arms around. If you buy a $1 million 10-year term life policy, that you're going to have coverage for 10 years. And if you're still alive at the end of 10 years, the insurance company keeps your money. It's really there to protect you when you're young against that risk that if you pass away, that you could leave money for your wife. But that's a term policy, and it's very easy to get your arms around. The insurance company collects premium, they pay out claims, and there's hopefully, if they've done things right, there's money left over for profit to the insurance company. Permanent life insurance, on the other hand, is going to pay a claim someday. So to understand how permanent life insurance works, you really need to put yourself into the position of the insurance company and think about how they might do it. And if I were the insurance company and I was designing a life insurance product from scratch, I would want the premium to be high enough so that the policy owner is saving up the death benefit over the life of the insured. So you design the premium such that you collect as little money as possible, assuming some worst case growth rate assumption in the market, also known as the guaranteed rate, right? Because that's the lowest rate that the insurance company is sure that they'll make. And that policy owner will be saving up the death benefit over the life of the insured. So that is easy to understand, but it also you have the risk of the insured passing away. So how do you account for that risk? Well, insurance companies can essentially, if you think on a very small scale, they could go out to a reinsurance company and buy a 1-year term policy to cover that person's life for 1 year. And then the next year they collect new premium. They've got new cash value accumulating, and now they need to basically go out and buy reinsurance to cover that new delta between the death benefit and the amount of cash value that you have. And that process repeats itself over and over each year. And each year, the amount at risk of the insurance company is going down while the cash value is accumulating. So on this graph that we're looking at here, you can see everything that we're talking about. The blue line is sloping up and to the right, and that's the cash value, essentially starting at 0 and growing at whatever interest rate we're projecting, right? That's the rate we're trying to answer today. What is that appropriate rate? So, and then you see that the cash value grows and eventually meets the death benefit, the orange line, at the 1 million mark, sometime out in the future at the person's life expectancy. So, if we just get off subject here for a second, if we assume that cash value grows at a rate faster than we projected, then that line would slope up and to the right at a much steeper rate, and it would intersect with the death benefit earlier than we've projected. If the cash value grows at or earns a lower rate of return, then that line would grow at a shallower rate and there would still be a lot of risk in the policy as that person gets older. And the cost of that insurance could be a problem. I mean, is there enough cash value in the policy to keep the cash value growing and cover the cost of insurance that has to be paid for? So the bracket on the left side of this chart is showing the amount at risk at the very beginning of the policy. So this is a 45-year-old with a $1 million policy. And basically on day one of the policy, they've got very little cash value in the account, but the insurance company needs to be ready to pay that $1 million claim if something were to happen to the insured. So they basically can go out to the reinsurance market and buy a 1-year term policy for $1 million to cover that risk. And then over time, by the time you get out to age 79 here, you can see that the policy now has about $500,000 of cash value in it, and the insurance company is only on the hook for the other $500,000 to make up that death benefit, total death benefit. And then And you can see that that continues on and ultimately reaches the $1 million and pushes it up once the client reaches age 113 or so. So this is an example of a maximum overfunded life insurance policy. This is the complete polar opposite of the minimum funded policy. So where the goal of a minimum funded life insurance policy is to get as much death benefit as you can possibly get for the money you're spending, here the objective is truly to spend as much as you can for as little death benefit protection. And here we're counting on getting as much cash value as we can out of the premium dollars, because the cost of insurance is a load on the policy, and it's eating up your premium dollars. So again, what we're going to be focusing on today is what is the insurance company doing with that money, and what kind of rate of return should we reasonably expect on the cash value. These are the basics. The only other remaining question on Life Insurance 101 is what is the insurance company doing with the money? I'll kind of fold that in with the discussion of whole life and indexed universal life as we move on here. So now that we've gotten the basics out of the way, let's stop and take a look at what's going on in a whole life. So I went online and I downloaded the annual report for MassMutual. And in that annual report are graphs showing what they're investing their money in. And in the case of any life insurance company, the cash value is invested in U.S. treasuries, bonds. They buy tons of mortgages off the banks, preferred stocks, for the most part, safe, secured debt instruments that pay interest every year. They don't have a lot of risky investments, but that's not to say that they don't have risky investments. So this graph is showing the holdings for MassMutual. MassMutual is well known for their high dividend rates on their whole life product. And you can see that their portfolio is made up of mostly bonds and mortgages. And once you get down past the preferred bonds, I mean, you've got the bulk of their assets being in those safe, secured debt instruments. The question we need to answer is, what is the appropriate rate of return that we can expect on those bond holdings that they have? So I went online over the weekend and I got the latest Moody's corporate bond yield. And right now, the rates are extremely low. I mean, if you look at this graph of interest rates, you can see that we are at the, I don't know if that's an all-time low, but I mean, I have not seen interest rates that low in my lifetime, certainly. Are those low rates the rate that we should use to project forward on the life insurance policy? And one thing I want you to keep in mind is that if we look at those holdings for MassMutual, for example, those are bonds that they've held for a long time. So really, it's only the new money that's coming in through premium that is being exposed to or forced to purchase into a market where yields are so low. Much of their bond holdings was purchased many years ago, and the yield on those is the yield that was in place at the time that those assets were purchased. And insurance companies have a much longer planning horizon than most of us. So when they buy bonds, they buy them to hold to maturity and lock in that yield to maturity that they've got. So even though interest rates have fallen, what that really means is that the value of their holdings has gone up. I mean, if you know anything about bond pricing, as interest rates fall, the prices of the bonds go up because people want bonds that have higher yields, so they're willing to pay a premium for it. So even though interest rates have fallen, the holdings of the insurance companies they're falling too, right? Because all of their new premium is also getting placed into the market at ever lower interest rates, as we can see from that declining interest rates over the last few years here. So they are faced with lower interest rates, and you are seeing whole life companies lowering their rates each year. I mean, the highest yielding companies, I mean, if you look at a graph over the last 30 years, you'll see that the dividend yields are like just in a steady decline for all that time. And it really goes back to the late 70s when interest rates were double digit. And ever since then, I mean, interest rates have been in almost a slow, steady decline ever since. And even a few years ago, if you would have asked me if interest rates could go any lower, I probably would have thought, no way, we're at the bottom. But here we are. So it's important to keep in mind that the policy is going to be held for 30, 40, 50 years. And today's low interest rates are definitely not indicative of, or I hope are not indicative of what we're going to expect over 30, 40, 50 years. I mean, if you look back over the last 30 years, you would see interest rates that were double digit at one time in the early 80s. But they've been on decline ever since then. And I certainly don't expect them to stay at these low levels forever. So getting back to my initial story, remember I said if interest rates were to have fallen after you bought your policy, you would have been disappointed because the cash values weren't where you were hoping or expecting they would be. But in today's market where interest rates are at an all-time low, if we estimate too low on the interest rate that we're illustrating, it's quite likely that you will be extremely happy because now the cash values are going to outperform what we've got on the illustration. But I would personally like to see an illustration that's accurate. So the main point I want to put to you is you're in charge and you can ask the agent to use any rate that you want. I mean, there are upside caps on the rates that agents can illustrate just so that we don't put out illustrations that are too far-reaching, let's just say. But by the same token, we don't want to go too low. But within a range, we can illustrate whatever you want to see. All right, so this graph is showing just some basic statistics on the Moody's Corporate Bond Index. And you can see that the long-term average is 6.7%, which we haven't seen for quite some time. And the current most recent value is 2.41 on, and remember this is AAA rated bond holdings. And towards the bottom of the chart, if you look at the lower half, you can see the yields on some other categories or qualities of bonds. So take a look at that and just, you can use these as a proxy for what the insurance company is likely making on its cash values. And even there, I need to be careful because the premium dollars go into a general fund, and what they earn on that fund determines how much of a dividend or interest crediting they credit to the policy's cash value. So it's not like they're investing your cash value per se. They're just keeping track of it on paper and allocating a share of the general fund to you. So hopefully that makes sense. I try to keep my explanations as simple as possible, but I do want to give you enough detail to avoid getting comments down below from people that do know better. So the question is, if interest rates are down below 3%, how are life insurance companies maintaining dividends that are in that 4 and 5% range? And understand that again, they bought a lot of these bonds many years ago, and they hold the bonds to maturity. So the bulk of, well, we don't know that the bulk, right? We don't know what the mix of the portfolios are in terms of when they purchased them. But there are likely bond holdings that go back many years to when interest rates were much higher. And that's the reason that life insurance companies can still offer in today's market higher interest rates, higher dividend rates. So some whole life dividend considerations. Just keep in mind that interest rates will likely not be this low forever. The insurance company is purchasing assets for 30, 40, 50-year time frames, or investing their assets with a goal of 30, 40, 50-year time frames. So you've also got to keep in mind, your own age and how long you're going to be holding that policy. But one of the beautiful things about cash value life insurance is the insurance company is investing for that 30, 40, 50-year time frame. And your cash value is going to enjoy the fruits of the yields that they can capture by investing for a long-term hold like that. But at the same time, you've got the life insurance statutes, which dictate that insurance companies must make loans to their policy owners secured by the cash value of those policies. So you enjoy the liquidity that comes with a high yield from a long term. And that's like the best of both worlds. And I don't think a lot of people really grasp that when they consider life insurance. And then lastly, just remember that it's called an illustration for a reason. It's just an illustration. We're putting rates in there that we think the policy is going to achieve. It's not a contract, and you're not agreeing to something that's locked in stone. All right, so that's a way that we can try and estimate the proper illustration rate to use for whole life. So now let's turn our attention to indexed universal life. So the primary difference in an indexed universal life is that the life insurance company is taking the interest that they would have otherwise credited to the cash value in the form of a dividend or interest crediting, and they instead go out to the index options markets to hedge and try to capture as much movement in a market index as they can get with the money that they have to spend. So while they're doing their hedging, they're utilizing options. So in an index universal life, you'll typically see that there's a cap, let's just say 10%. There's a floor, 0. And the way an index universal life typically works is if the market index goes up beyond the cap rate, then you just get the cap rate. You don't get to participate in the index movement beyond that point. Anywhere between 0 and that cap rate, you get whatever the market gets. And then finally, if the market index goes down, your cash value gets credited with 0. So underlying those caps and floors are the fact that the hedgers are employing options. So the strike price of the option represents the cap, and if the market index goes down, your options would typically expire worthless because you could have gone out and purchased or bought the index at its lower value, so you wouldn't exercise the option. So it's the underlying options that really define the cap and floor of the indexed universal life. But the cash value itself is still invested in the bond market. So what I've got on screen now is another graph from the annual report of Securian, which is Minnesota Life Insurance Company, or owns Minnesota Life Insurance Company. And if we look at their asset mix, you can see that they're invested in basically the same thing that Mass Mutual was. Lots of bond holdings. And honestly, if you look at it really closely, you'll see that it's actually a much more conservative mix. They hold more higher quality debt in there. So under the hood, whole life and indexed universal life, the life insurance companies are doing the exact same thing with the money. Where they differ is what they do with the interest income that they receive. In the case of a whole life or universal life, they credit those gains to the cash value in the form of dividend or interest crediting in the case of a UL. But in an index universal life, the insurance company is going out to the options market with the simple goal of just trying to buy as much movement in the market as they can get with the money that they have. So what does that mean given today's lower interest rate climates? Well, just as in the case of whole life, the life insurance company still has holdings that are earning a rate of return or yield that is much higher than the current yield right now. But they've also got new premium coming in every day that is being exposed to those lower interest rates. So as interest rates fall, the life insurance company has less money to spend on hedging. So if they have less money to spend, they can't buy as much movement in the market. And over the last few years, we've seen a trend towards lower and lower caps on indexed universal life. And those lower caps are really a function of lower interest rates or declining interest rates. So one thing that I do personally is I like to validate the numbers that I see. I don't take the insurance company's numbers at their face value. And this goes back to defining how much income you can get from a life insurance policy as well as these caps. So what I've got here is, this is all publicly available information. You can go out and you can get the last 30 years of S&P 500 values and calculate a year-to-year change. And what I'm doing is I'm putting in the formula for an indexed universal life. So we've got a cap and we've got a floor. And I can put in whatever cap I want and basically look at those 30 years of historical S&P 500 returns. What would an indexed universal life earn given today's cap rates applied to the 30 years of historical S&P 500 returns? So the first column shows the year-to-year change in the S&P 500, and then the second column shows the year-to-year change if we apply the IUL formula to it, i.e. the interest rates are capped at whatever the cap is, or the gain is capped at whatever the cap is, and the floor is 0. So we're not taking part in the IUL is not taking part in the declines in the market. And then next to that, and it's two columns off to the right of that, I'm just looking at the growth of $100, both for the S&P 500 and for the IUL, or our hypothetical IUL. And down at the bottom, I'm kind of rolling up the numbers. So what I'm doing is looking at an annualized rate of return. So, and this is key, the rate of return you should always be looking at is the annualized rate of return, not an average. An average doesn't get you back to reality. You know, if you have a 50% decline in the market, for example, you need more than a 50% return the next year to get back to where you were. In fact, you need a 100% return to get back to where you were, right? So an annualized return takes into account where you're starting and where you're finishing. So the 5-year annualized return, for example, is looking at the value 5 years ago to start and looking where it is at the end and imputing the interest rate that it would take on a level basis to get from the beginning to the end. So if you overlaid a graph of what the market actually did, or IUL actually did, compared to a smooth interest rate that would get you from point A to B, they're all going to end at the same point. So the yield would be exactly the same. So keep in mind an annualized rate of return is what you really want to use. And if you're curious on the calculations that I use, I do have a blog post on my website. I'll put a link down below for that. And it goes over the calculations of an annualized rate of return. You can see what's embedded in the cells here. So what you see here, and I like to stress this, is the goal of an indexed universal life is not to capture the movement of the market index. Let me rephrase that. That's not right. People often look at indexed universal lives and make statements like, well, it's not capturing the dividend rate of return or the dividend yield of the index. And that's not the point. The point is simply to do better than they would have had they just simply taken the interest that they earned on their bond holdings and paid it as a dividend. So the goal of this hedging is not to get the return of the market index. It's simply to do better than they would have, to capture some premium over the debt market rate of return. So the key takeaway here is to look at those IUL 5, 10, 15, 20-year returns and compare that to the Moody's Corporate Bond Index average that we saw on the previous page. You know, given the interest rate income that we're earning on our holdings, are we capturing a premium over that to justify the effort of hedging? And if you look at this, you can see that there's about a 2.5% premium on the IUL return compared to where the Moody's Corporate Bond Index average is today. Now again, you know, we have to keep in mind that we don't know the age of the holdings of the insurance company. We don't know how much they're making, whether they're yielding closer to 5% on their cash value, on their general fund, or if they're down around that Moody's Corporate Bond Index average, because that's just a snapshot of today. It doesn't take into account how long they've held the assets. But it does give us at least a framework to analyze the returns, and that's the key. So key takeaway here is we don't know what the markets are going to do interest rate wise, but as you can see here, as interest rates go back up again, the insurance company will have more income with which to hedge, and then the caps will go up, and the rising caps will allow the indexing strategy to capture a greater proportion of the movement of the market index. So we can expect a higher crediting rate in the future if interest rates go back up again. So again, what is the appropriate rate to use going forward? It's whatever you feel comfortable with. You know, I don't want you to be disappointed, and I don't think you want to be disappointed yourself. So I tend to be very conservative on the interest rates that I use on my illustrations. Another consideration is the equity premium. So as interest rates go back up again, the insurance company will have more money to spend on options, and they'll be able to capture more of the market movement. So the premium over the interest rate and what they're capturing in the index is going to hopefully stay relatively constant. I hope that makes sense. As the market, we're not after the market returns, so to speak. We're just after earning more than we would have had we paid the interest earned as a dividend, right? So as interest rates go up, are we still maintaining that 2 to 2.5% buffer or premium over what the current yields are? And lastly, just keep in mind that this is an illustration. It's called an illustration for a reason. It's just a projection. At the end of the day, an index universal life is an entirely mechanical process. Their bonds are, their cash is invested to earn the greatest return that they can possibly get, because the faster the cash value grows, the faster the insurance company's risk is eliminated, right? So they have an incentive for the cash value to do as well as possible. So just remember that you've got the insurance company on your side, and they're taking the money that they make and they're going out to the options markets to basically capture as much movement in the market index as they can get with the money that they have to spend. An entirely mechanical process. There's no board of directors deciding what they're going to pay as a dividend this year. What they make is what they credit. So just like money in the stock market, you don't know what it's going to do each year, but you understand the process that's going on under the hood. And that's the important thing. As long as you understand that process and you know what to expect, you've got a good idea of what that policy or what your cash values are going to do over the lifetime of your policy. So wrapping things up, I want you to understand that you're in charge. You can ask the agent to use any interest rate projection that you want. We don't have the flexibility to go too high, but if you want to see low, we can go as low as you'd like. Interest rates are not going to stay where they are today for the lifetime of your policy. So we just have to think about what interest rates are going to be over the lifetime of your policy and just try to get as reasonable a rate of return as possible. And there's no hard and fast rules, we just have to take a guess. Another thing to keep in mind is that in a compounding interest series, the early years do make a big difference, because obviously the more money you can get up front, the more money you have compounding down the line, right? So if we're off and we estimate too high, it might breed disappointment down the line as the policy's cash value, even though rates are going back up, still may not catch up to the point where your illustration, where the policy was illustrated. And again, just remember that it is an illustration and it's going to be wrong from day one. So with that, I'd like to thank you for tuning in and watching this. If you've got any comments, I'd appreciate your feedback. Let me know in the comments down below if there's any topics that you'd like me to cover. If you think there's anything wrong in what I've presented here, by all means, write a comment down below. I'll respond. In fact, my thought is that people are going to be finding these videos for many years to come, and I encourage asking questions in the comments down below and letting me answer those questions, because people are going to be stumbling across this for years, and I want the answers to common questions to be there for people to use to learn. But I also have my Facebook group called The Double Play. So if you're interested in learning more, but you're not ready to talk to an agent yet, go on Facebook. Actually, go down to the description. I've got the link down below to the Double Play group. It's a group of my clients plus many others who have joined us now that I've been putting the YouTube videos out there, who are interested in this subject. And it's a forum where you can ask questions of the group of people who are really putting this to work in their real life, and get the answers to your questions without ever talking to an agent. There's also my website. So I've got a ton of free resources available on the website. I call it a no fluff zone. So there, a lot of websites are fluff. They want you to give up your email address before they'll give you any information, and even then, it's not going to be what you want. Here, you can find the answers to virtually anything short of seeing an actual illustration, right? You need a life insurance agent for that. But everything that you need to know in order to evaluate life insurance is there. So also in the description down below, you'll find links to the Life Insurance 101 paper that you can download off my website, as well as a paper explaining how the double play works. That's a free download. You just got to give up your email address to get that. And in my store, I've also got another paper on the one big policy design mistake that could cost you thousands. And for the price of buying me a beer, you can learn how to avoid making one giant costly mistake that will potentially cost you thousands of dollars. And it's a common mistake, so either go to the store or hunt down the few videos where I've actually given it away. So with that, again, thanks for watching, and I look forward to seeing you on the next video.